Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Jake Remley, Senior Portfolio Manager at Income Research and Management, to discuss the bond market outlook for 2024 and which sectors within fixed income see value. Jake, it's great to have you back with us. Welcome to Trade Talks.
Thanks for having me, Jill.
You got it. What's your outlook overall for the bond market in 2024?
Yeah, so we're cautiously optimistic here. The Fed is done, in our opinion, with hikes. So the bond market could start to put up some pretty solid total return. We've seen that in the past at this point in the Fed cycle. We are a little nervous about the fiscal policy side. It seems to be playing a larger role, especially this year with the election, and that piece of it could continue to drive volatility.
Are there any sectors within fixed income that you see value in?
Yeah, we really like high quality corporate bonds all the way down to BBB. The ability to get up above 5%, in some cases close to 6% on yield, should be a tremendous cushion if we do continue to have volatility. And that piece of it, I think, will be an important component of total return going forward here.
Let's switch gears and talk about the macro for a moment. What are your thoughts on the yield curve, front versus longer dated?
Yeah, so we don't see the yield curve flattening much more from here. It's amazing because about a year ago, we were significantly flatter. The 2-year was 100 basis points over the 10-year. However, given the Fed is now signaled that they're done with hiking, we see a steepener as a more significant risk. So either you have sort of a gradual steepener as the cycle continues and the economy stays robust, or you have some kind of shock recession, and the 2-year rallies far more than the 10-year. That's really historically how it's played out. So I think that would be consistent with what we're seeing right now.
And outside of an event like a recession, what's your outlook on Fed policy and the potential for rate cuts moving forward? Because it really seems like whether it's fixed income, equities, or virtually any market that you're looking at, everyone is hyper-focused on how much, when, and the cadence of the cuts, if any at all.
Yeah, we think the market's gotten a little bit too excited about this prospect of cuts in the first or second quarter here. 6 cuts priced into the yield curve as of this morning doesn't seem, for 2024, doesn't seem to us to be quite as fast as we are seeing core CPI come down. So if you looked at core CPI, it's still up about 3.9%. If you sort of just trend that out, it's going to take several more quarters for it to get down even below 3%. And that's going to keep the Fed, I think, in a very balanced position.
You know, it's interesting. Strategists such as yourself that come on the show feel that 6 cuts are too aggressive, or that the market isn't telegraphing it correctly. But it seems to be as if whether it's fixed income or the equity market, it doesn't really seem to factor that in much. Whereas, you know, every fundamental strategist that we've spoken to thinks that it's too aggressive, or at least you won't get any more than 25 basis points at one cut in time or the other.
Yeah, you know, I sort of take it with a grain of salt when I see kind of the mean of what the market is, you know, coalescing on, because it really can be a sort of tail driven outcome. And so if you do have a recession, you're going to have probably many more than 6 cuts. And that can really bring down sort of the overall mean where the market ends up. But, you know, the reality is it's far more likely that they don't cut, or they cut a couple times just to sort of balance out their policy here for some time. But the idea that we have 6 and not 12 or not 0 is, I think, a little bit misleading from the market pricing standpoint.
All right, Jake, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you, Jill.